Welcome to the TreppWire Podcast, the show where commercial real estate meets data and insights. This is our week in review for the week ending June 12th, 2026. I'm Haley Keene with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Lonnie Hendry, Chief Product Officer, and Stephen Bushbaum, Head of Applied Research and Analytics. This is a fun one for us because today we are recording our 400th episode of the TreppWire Podcast. When we started this show back in March 2020, we thought it would be a way to help make sense of an incredibly uncertain market. 6 years, nearly 2.5 million listens, and 400 episodes later, we're still here talking commercial real estate, structured finance, credit markets, and all the stories shaping the industry. We do have a few 400-themed surprises sprinkled throughout today's episode, but before we get there, let's start with the macro backdrop. It was a lighter week for major data, but CPI gave us plenty to talk about. Headline inflation moved higher in May, largely because of energy, while core CPI was more contained but still above the Fed's target. On today's episode, we'll also recap some of the major themes from the CRE Finance Council's June conference in New York, where the tone seemed to be that liquidity is healthy, lenders are competing, CRE CLO issuance remains a bright spot, and alternative lenders are continuing to evolve from last resort capital into preferred lending partners. And we'll also give a closer look at the composition of refi and acquisition activity across new issuance on today's show. And also, if you are listening from New York or you're a fan, it's probably an especially good day. The Knicks pulled off a crazy win on Wednesday to take a 3-1 lead in the finals. So Stephen and Lonnie, a lot of excitement in the air for today's episode. Let's start at the top. Between the CPI release and the CREFC conference this week, what stood out to you the most?
Well, the main macro inflation takeaway is that the higher for longer is alive. It's sticking around probably for the rest of the year. That headline inflation moved higher. Energy was obviously the big driver. So you don't want to overstate the read through to broader inflation, but short story long or long story short is that, until this oil crunch goes away, which it doesn't look like that's happening anytime soon, given the renewed tensions. Yeah, I know a peace deal is being brokered, but it's going to take a little while for this thing to smooth out. So yeah, it's probably going to carry through until most of the way through the second half of the year. So for CRE, that reinforces what we heard at CREFC. Don't count on cap rate compression to bail out values. If rates stay elevated, cap rates remain sticky, the path to value creation has to come more from NOI growth, operating performance, and asset selection. But Lonnie, you were actually at the conference. So can you give us some read-through or feedback as to, really how the CREFC conference was?
Happy to do that. Go Knicks go. Can you believe the finish to that game, Stephen? It was incredible being here in New York City to witness that, even just on TV while I was working still. Hearing the fans chanting down below from my hotel room window for like 2 hours after the game was pretty awesome. So I can say the tone at CREFC was not as excited as Knicks fans were last night after their victory. But it wasn't all doom and gloom either. I'm boycotting the cautious optimism, but I would say that the tone was cautiously constructive. I think the one major agreeable point was just that liquidity is still available in the market, and it's available at a level that is beyond what the transaction activity would suggest. So, there were a lot of comments made around the market, being active, but an over-reliance or a significant proportion of the deals being refinance and not sales transactions, which we're going to do a little deeper dive on today. And you hit on one of the other stories, Stephen, on the CRE CLOs. When that issuance is 2x conduit issuance, it raises a bunch of questions, and people are kind of looking at the market and saying, what are we doing? But there's a story and a reason why that market is where it is and conduit is where it is. I think the one thing I would add is on the CRE CLOs is it's a little interesting. You did a case study analysis for one of our Market Pulse webinars a few months ago, Stephen, where you looked at a couple of sample portfolios, and surprisingly, a disproportionate amount of the CRE CLO activity was new construction multifamily that hadn't leased up yet. And so they were just going back into a bridge product. So we'll see if that actually plays itself out positively or negatively. But, for investors, there's still opportunity. They're not just able to kind of pick and choose. I mean, I think what this is I think someone referred to it as a sharpshooter's marketplace. So, what we're saying is it's not an easy market. It's functioning. If you have good assets, you have realistic business plans, there's definitely more than enough capital available. And I think for the takeaway, overarching takeaway is just that everyone thinks we're in a pretty good spot, all things considered. But I think there was definitely a lot less optimism than what we saw coming out of the January conference down in Miami.
Yeah, which is funny given the issuance volumes. I mean, I wonder if some of the tone is maybe a selection bias that a lot of the deal makers just weren't in attendance. And so maybe you had a bit of a mindset selection bias from the crowd.
Well, I think there's definitely some of that in the sense, that some of the folks that are doing deals probably weren't sitting, in a New York hotel lobby for 3 days, listening to people speak. But at the same time, I think people are really, one of the things that I took away was just the constant discussion about the issuance being refinance driven. It's almost like it's not a negative thing, right? But that people just want to see sales. I mean, one of the comments was, as it pertains to like value discovery or price discovery, was with all of the refinancings, you get appraisal values, but you don't get transaction values. And so there's still some discovery left in the market because you haven't had enough sales transactions in a lot of markets to actually determine what is the real value of some of these assets. And so, in our discussions, we met obviously with a bunch of clients. We had a bunch of just podcast listeners that stopped by. And, I would say on the whole, people are still positive, but I think it's all of these things. It's not just one thing. And, Stephen, I think you do a great job every week of kind of going through the macro and highlighting this. But if you look at all of the different constraints, the Iran conflict, this persistent inflation that doesn't go away, jobs that are a little bit, iffy, it seems like month to month at this point, the tech AI bubble or boom, depending on which side of the fence you sit on. There's all these things that are just constantly creating tension in the market that I think some people are just a little bit tired. Like, we know what we know, but people would like to have some of these things kind of be a little more finally determined. Like, are we going to get a peace deal? Check, let's get that done. Is inflation going to require the Fed to take action? Like, let's get that done. Are we going to see some real positive gains in the market from AI productivity and, AI value creation? Let's get that done. All these things are there. And so people are navigating them and they're doing it in a positive way. But there's just this like inherent tension because all of those things are not finally determined at this point, if that makes sense.
It does. There's just a lot of uncertainty in the batter right now, and we're not sure exactly what we're cooking.
So Lonnie, you mentioned that there was, a lack of acquisition sales versus what we're seeing with refinancing. And Stephen, you mentioned some of this when it comes to new issuance last week. So I know you pulled some data on total issuance and really digging into the refi versus acquisition activity. Let's walk through that in a digging through the data segment for our listeners.
Sure. So for fun, what I did is I went back and pulled, first off, total issuance going back to 2006. And then as part of that, I looked at the loan purpose. So as part of the disclosures, you get the sources and uses of funds for loans that are going into CMBS pools. And so that allows us to, effectively roll up at an aggregate level what percentage of new issuance was driven by refinance activity, acquisition, or something else. So generally, refi and acquisition are the two dominant categories. So if you look back through history, really from what I would call the restart of a normal market in about 2013, granted things were still fairly depressed, but 2013 was really starting to look, more like a normal market at that point. So 2013 through 2022, the broad average was the low of about 20% of CMBS issuance was tied to acquisition activity. So on the low end, about 20%, tended to teeter around 25% really through the mid 2010s. So 2013 through 2019. Then when you get to 2020 through 2022, right, rates dumped. And so that really triggered a lot of transaction activity. So 2020 was still a fairly normal year, 20% of activity tied to acquisitions. In 21 and 22, it was 38 and 34% respectively. Then with the Fed hiking rates, acquisition activity fell off a cliff. So in 2022, it was 34% of new issue was tied to acquisitions. That dropped to 10% for 23 and 24, and then 8 and 9% for 25, and so far year to date in 26. So on the other side of the coin, in 2026, 59% of that activity is tied to refinances. It was 70% in 2025. And it was still a pretty healthy 65, 63% in 23 and 24. But really, the historic average tends to run right around mid 50s to low 60s is how much of that issuance activity is tied to refinances.
I want to jump in there real quick, Stephen. I love that you put this together going all the way back to 2006. And, it seems like, and this is a very simple, just mathematical computation, not any type of model driven or any derivative of any type of, complex thinking here. But if you look at when that threshold gets above 32% acquisition or 30% acquisition, I would suggest that indicates that we're probably in a little bit of a valuation bubble. So if you look at 2007, 32% acquisition. If you look at 2021, 38% acquisition. 2022, which we know the first 6 months of the year was actually outpacing 2021 till the Fed came in and started raising rates, but it was 34% acquisition. I mean, do you think that that's kind of a push-pull for indicating whether you're maybe in a little bit too frothy of a market?
Oh, absolutely. Absolutely. Anytime you see that acquisition activity get into the high 30s, I mean, shoot, even low 30s, we should start questioning things, but mid to high 30s, yeah. Perhaps the things driving transaction activity are not the most healthy for long-term sustainable valuations.
In my 20 plus years of CRE experience, it feels like it's been a while since I've tried to do any of this, official calculation, but in an average market, I would say in any given location, whether you look at MSA or you look at city or you look at the zip code or you look at a region, 1 to 3% of the total property population will trade in a given year. And so, I know we're looking here on just like the subset of data is properties that actually have had a financing transaction. So it's a slightly different calculation. We're looking at just the composition of what has been financed. But in a typical market, you might see 1 to 3% of the properties trade in a given year. And I think we're on the lower end of that spectrum now, but I don't think we're outside of that range if we're looking at the data holistically. Like, that's the part that I think is interesting. Like, I get the sense from CREFC, and I get the sense just in some of the other discussions that we've had with some clients and other participants in the market, is like they're almost using that 2021 as kind of the most recent benchmark of a really solid market. And I would say 2021 to me is a little bit of an anomaly or outlier just because of everything that happened with the stimulus and everything else. It's, probably like 2019 to me would be more of a apples to apples type of comparison.
Oh, I completely agree. I mean, interest rates were at the lower bound. To me, that's not normal financing conditions. I mean, that is the world of cheap money, right? And what's really fun is, okay, in the aggregate, Lonnie, you said if we reach that low to high 30s range in aggregate, that seems to point to a little bit of a frothy market. When you go by property, certain things stick out like a sore thumb. If you look at 2021 and 2022, multifamily, how much of that activity was acquisition based? It was 47 to 50% in those 2 years. Talk about frothy. Lodging, though, even more eye-opening. It was 63% in 2021 was tied to acquisition activity and 38% in 2022. Now, if you go back leading up to the GFC, where were the apparent hotspots? Well, multifamily was 35%. That weathered the storm fairly well, all in all. So you don't want to get too worked up on that. Again, that's a bit of an extreme tail event. But office, we know that office suffered, a pretty good bit down the road. It was 39% and retail was 31%. So 31, I would say, yeah, 30 to 31%. That's the lower end of the threshold. But then when you get into the 40s and 50s, I mean, that's when you know something is going to break.
Yeah, I mean, if you look at that multifamily stuff, and for those listening, send us an email at podcast@trepp.com, and we can send you a couple snippets of this calculation that Stephen's pulled together. But, let's just go through those a little bit more granularly. So 2019 in multifamily, Of the, 13 plus billion of origination, 20% of that was acquisition related. 2020, obviously COVID shut things down. We're seeing 5.5 billion, 15% acquisition. 2021, 19.3 billion, 47% acquisition. I mean, that is insane. And then 2022, again, the first half of the year was on fire. 8.8 billion of origination, 50% acquisition. And if you look at 2023, it drops to about 3%. So I think this is just proof positive of, we've talked ad nauseum about the bid-ask spread between buyers and sellers and when will there be capitulation on pricing, and everyone's sticking to that 2021 valuation. Well, and it's because in the multi-sector in particular, in the deals that we track, 47% of those deals had acquisition as the transaction type. And those prices, as we know, with cap rates in the threes and interest rates at zero, were just unsupportable. I wish we would have done this analysis sooner because this is pretty eye-opening. And then you look at 25 and 26 for multi, you're at like 6% and 10%, respectively, which falls right in line with kind of what I think you should see in a recovering but stable market.
Well, fortunately, Lonnie, we'll have a lot more time to dig into this topic at the monthly Market Pulse webinar here later in June.
Yeah, we're gonna do a nice deep dive on this because I'm intrigued, and I think that the lodging's a little more easily explainable. You see the huge jump in 2021 up to 63% acquisition, but that's on the heels of effectively hotel industry being shut down in 2020. And then when things came back in 2021, RevPAR and ADRs jumped through the roof. And so you're able to buy some hotels at really great prices because current owners were struggling and, revenues were really strong. And so you're definitely getting some upside, in a very short time frame. I think we've seen that pull back to more historical norms post 2021. But yeah, we'll definitely do a continuation of this on the Market Pulse. One other thing I did want to mention around CREFC and just kind of get your thoughts on this, Stephen, was, and it's not something that's a new concept to us. And so, obviously being a little bit biased and proud of our work here, I think even with this conference, we've talked about every topic that I think that was discussed at CREFC in some form or fashion on our show, either very recently or in some cases even over the last couple of months. So there really wasn't any panel discussion or any topic that was, net new to our listeners here. I mean, I think the most prolific discussions at this year's conference related around AI and data centers, which we have covered in significant detail. But one of the other comments that kind of stuck out to me, because I think we've talked about this quite a bit, is the importance of skilled and experienced operators in today's market. So we kind of framed today's market as a sharpshooter's market. And I think part of that narrative is operations are a very key component because you're not getting the value appreciation through cap rate compression, et cetera, et cetera. What are your thoughts on that, Stephen? Knowing that we've discussed it, but hearing, some kind of undertones from the conference being the importance of the role of experienced operation.
I mean, I think that's just a universally true concept, in my opinion. But, if we're being honest here, you can get away with being more middle of the fairway as an operator and still see really good appreciation if you get lucky on timing. I'm not going to pretend like too many folks are really able to time the market. Now, it might look that way sometimes. One of my favorite examples is the EOP office portfolio in 2007. I mean, talk about top ticking it. That was a massive transaction that was executed at arguably the last point in time it could have possibly been executed pre-GFC. But, at the end of the day, it's less about a timing story, more about just your operational experience, right? You can operate through a downturn and manage through a downturn, as a lot of these modifications have shown us. These properties end up being stressed, but not de-stressed and doomed to foreclosure, right? When you still have a good operator in place, they can make the argument to the special servicer, look, if you get rid of us, this property will be worth less because we are the strongest and best management hands to be holding this asset. And that argument does carry weight with special servicers when the operator can actually prove that out. And that's why we've seen so many modifications is, well, folks have learned how to play the game in this space. And so these modifications don't take nearly as long and are fully prepared to tell the story the minute that loan transfers to special servicing.
Yeah, that was another, I think those are all valid points, and I agree with you. I do question at some level, though, in the multi-space in particular, where you had such a proliferation of syndicated, capital raised deal by deal, inexperienced operators. There's a lot of distressed multi with very inexperienced operators where the servicer doesn't have the luxury of having someone that can actually navigate this, and then that puts them in a really tough position. But it feels like that, all the private credit guys that we're speaking were basically saying that's why they've been so successful, because they do have the operational chops in a lot of examples to come in and effectively loan to own if they need to. There was one of the panelists that effectively said, they took an asset that had come back. The current operator couldn't perform. They took over. They executed a business plan, and an asset that they had taken back as special effectively turned for $100 million profit for them because their operational expertise allowed them to reposition the asset. I think even in the absence of experienced operators in the deal, some of these private credit folks are able to come in, provide some form of lifeline. If that doesn't work, then they effectively step in and reap the benefits of their, decades worth of experience and, access to capital and other things that maybe some of these smaller operators just don't have.
So let's get into some deals and data. For our 400th episode, we wanted to do something with the number 400. And after several ideas that maybe were more entertaining to us than they would have been for our listeners, we landed on this. Let's look at a few major CMBS properties with addresses in the 400s. Now, the address isn't really the point. What caught our attention were the stories. Some of these deals touch on long-term ownership, hotel valuations, office lending, sponsor strategy, and some of the biggest assets we've seen come through the securitization market recently. So, Stephen, let's start with one of the more interesting ones, the JW Marriott Marco Island at 400 South Collier Boulevard.
Yes, I love it when an idea like this takes shape and you start seeing signs that you are trudging down the right path. Because some of the stories that you're about to hear were recent securitizations, which in my mind told me this is a fantastic topic because we have very timely information here. And these are what I think are fairly interesting CMBS stories. So this JW Marriott Marco Island Beach Resort is a JV between Sculptor Diversified Real Estate Income Trust and Trinity Investments. They picked up one of Florida's most iconic beachfront resorts, the 809-key JW Marriott Marco Island, for $835 million. They financed it with $690 million of floating rate CMBS debt that was securitized as a standalone SASB or single asset, single borrower deal through Wells Fargo and JP Morgan. And that transaction closed on May 15th of this year. So this is a very recent new issue deal. So our data shows that the property is throwing off roughly $260 million in total revenues on a trailing basis, with an NOI around $90 million and a debt yield north of 13%. So this is a clean loan trophy asset with a 2028 maturity that has extension options that can push the maturity out to 2031. So the collateral itself is the 809-key Marco Island Beach Resort, which is a luxury beachfront resort on Florida's Gulf Coast. The property sits on more than 26 acres with about a quarter mile of controlled beachfront, and the amenity package is substantial. Multiple food and beverage outlets, 5 pools, a 24,000 square foot spa, significant meeting and event space, 2 nearly 18-hole golf courses, and a private membership club. And what makes this deal especially interesting is that this is not the property's first trip through the SASB market. This property also backed the JW 2024 Marco deal, which was a $590 million refinancing in 2024, before this deal returned in 2026 as part of this $835 million in acquisition financing. Now, here's what's worth pausing on. The seller was Barings, the asset management arm of MassMutual, and they own the property, get this, Lonnie, for over 40 years. And you don't see that all that much anymore, and it's worth understanding why it happened in the first place. Life insurance companies are the original long-duration real estate investors. Their liabilities, think whole life policies and annuities, can stretch out sometimes like 30, 40, even 50 years. So historically, they matched these long-lived hard assets against those long-lived liabilities or obligations. No fund redemptions, no quarterly earnings pressure, no LP asking for their money back, just steady cash flow compounding quietly on the Gulf Coast of Florida. Now, here's where the LTV gets interesting. This loan comes in at 72.6%, which sounds aggressive on an $835 million purchase price until you remember what's in that collateral package. It's not just the hotel, but those two 18-hole golf courses in Naples, Hammock Bay and Rookery, which anchor the valuation and give the lenders a broader asset base to underwrite against. And that's meaningful cushion. With a debt yield north of 13% and a DSCR sitting around 1.95 times, cash flow coverage is doing real work even in a floating rate structure. Now, when Barings finally decided to sell, it wasn't a distressed situation. This was a deliberate kind of portfolio management decision. They put $320 million into renovations before their exit, rebranded the property under JW Marriott flag, and handed over the keys at peak value here. So for CMBS investors looking at this JW 26 Marco deal, the seller history matters. You're not buying someone's problem, you're buying someone's prized possession, and that's a very different starting point.
Yeah, I think this is a cool story. I mean, for all of the things you just outlined, and it's, when you're buying someone's prized possession, there's usually goodwill and everything that comes in that transaction. Like the seller is at a point where they've decided it's time to offload or move a different direction after decades of ownership. I bet this was a pretty cool deal to be a part of. And talk about incredible asset. I mean, this is a one-of-one type of asset. JW Marriotts are always nice, but the way this is situated on 26 acres right on the beach, I mean, pretty impressive property.
So next up in our 400-themed CMBS tour is Lyrik Back Bay in Boston, tied to 400 Newberry Street and 1001 Boylston Street. The property backs BOS 2026 Lyrik, which is a $360 million SASB deal secured by a non-recourse first lien mortgage loan. That loan is fixed rate, interest only, and has a 5-year term. So this is a very different profile from a lot of the floating rate transitional deals that we sometimes will talk about, or just really in general, typical floating rate SASB structure. In this case, the story is less about a repositioning play, more about a newly built high quality Boston office and a retail asset with major anchor tenancy. The collateral is the 20-story Lyrik office tower in Boston's Back Bay, a 2024 vintage Class A LEED Gold certified property built over the Massachusetts Turnpike and MBTA rail lines. The securitized collateral totals roughly 495,000 square feet, mostly office space with a smaller retail component. And as of April 2026, the property was 93.4% leased to 11 tenants, with Car Gurus and Lego serving as the two dominant anchors. The broader Lyrik development is also notable because it helps bridge Back Bay and Fenway through a 2-level public plaza with the adjacent Citizen M Hotel at 400 Newberry Street, restaurants, retail, and outdoor gathering space. So for our 400th episode, Lyrik gives us a very nice 400 address example that captures a bigger CMBS theme. Even in a still challenged office market, lenders and bond investors are making room for those newer, highly amenitized, well-located assets with strong tenancy.
Yeah, and I think in this case, the transit-oriented component here makes this very desirable. We haven't really seen a lot of action, Stephen, on some of these LEED certified buildings like I think people expected. But it is nice to see that sometimes those buildings trade, and maybe there's some value add from that additional spend that the developer had to go through to get those certifications. And I think this is just a continuation of what we already know. Office properties that have 93+% occupancy efficiency are very, very desirable in today's market, given where the overall sector is at.
So for our next 400-themed CMBS stop, we're headed to Palm Beach Gardens, Florida, where the PGA National Resort sits at 400 Avenue of Champions. The property backs PGA Trust 2024 RSR2, a $315 million single borrower SASB transaction secured by a first mortgage lien on the resort. The loan was originated in May of 24 by Morgan Stanley and Wells Fargo, structured as a 2-year floating rate IO mortgage with 3 one-year extension options. At closing, the deal looked like a classic post-renovation resort refinance, where the proceeds were expected to refinance existing debt, cover closing costs, and return approximately $55.6 million in equity to the sponsor, Brookfield. Now, based on the prospectus summary, the loan had a 66.7% LTV against a $472 million as-is appraised value, with underwritten net cash flow of roughly $33 million and an underwritten NOI debt yield of about 11%. The collateral is the PGA National Resort, a 500-plus acre destination resort and private club anchored by golf, group demand, wellness, and membership income. The resort includes 339 hotel rooms and suites, 21 two-bedroom cottages, roughly 60,000 square feet of event space, a 40,000 square foot spa, 35,000 square foot sports and racket club, multiple food and beverage outlets, and get this, Lonnie, 6 golf courses totaling 99 holes. The champion course is the marquee piece of the story, with a tournament history that includes the Ryder Cup, PGA Championship, Senior PGA Championships, the Honda Classic, and today's Cognizant Classic. So Brookfield acquired the property in 2018, then invested roughly $113 million in renovations and operational improvements between 2019 and 2023, including guest rooms, restaurants, spa, meeting space, golf, and club amenities. Since securitization, though, this property has actually changed hands. Henderson Park, in partnership with Salamander Collection and South Street Partners, acquired the resort from Brookfield in early 2025 and assumed the CMBS loan. KBRA affirmed the deal's ratings in June of 2026, though it noted softer financial performance since securitization.
You know, Stephen, I got 99 problems, but a golf course, not one. This is a pretty sweet deal. That's a little Jay-Z reference for those that don't know. Pretty crazy to have 99 holes. Incredible, Ryder Cup, PGA Championship, Senior PGA. That's a pretty impressive resume. Honda Classic. Pretty sweet deal. So this is one we don't really talk a lot about golf courses on the show or golf resorts. And so I'm glad that we got to get this one in on the 400th episode. Pretty cool.
I got to say, though, Lonnie, this is definitely one of those properties or loans that you don't want to have to take back. Because talk about having to be a specialty or specialized operator. You're running a small city here.
Well, you might not mind doing some site visits, just to make sure everything's going all right, and staying at one of the really posh two-bedroom cottages, doing an event at the 60,000 square foot event space, getting a little racquetball in and having some nice food and beverage. But I'm with you, operating these things. The golf courses just by nature are very challenging operating businesses, and membership income sounds great, and if you can do it well, these are great. I mean, you look at some of the largest country clubs across the US, and the ones that are operated efficiently and take care of their members have years long waiting list. But for every one of those, you have 15 or 20 golf clubs or courses or venues that have not been able to make it. So yeah, this one, that's why we don't see so many of these in our data set generally, because these are very esoteric kind of specialty type of operations.
It was funny when COVID hit, just how well a lot of golf courses ended up doing. I mean, that really kind of showed some of the problem with work from home on such a broad basis, because you shouldn't be having that much golfing revenue show up midweek, midday.
Well, I remember when COVID first hit, I actually lived on a golf course at the time, and they turned the holes upside down so the ball didn't actually go into the hole, so you didn't have to grab the ball out. They just turned the pin upside down so that, you had to hit it. It was almost like a pinball. That way no one was putting their hands inside the cup to get the ball out. But yeah, I had plenty nights taking the kiddos out there. We lived actually on a par 3 green, and so we got pretty good at that little reading that green and getting the ball to tip the cup, not to have to go in the hole. Man, it seems like that was forever ago, and it also feels like that was yesterday, depending on the day.
It's funny you say that, because I too lived on a golf course during COVID back in Lubbock, and they didn't turn our holes upside down because Well, I mean, you're in West Texas and you deal with some, that ain't flying here, buddy. So what they did was they cut off part of a pool noodle and stuck it down in the hole so the ball wouldn't go all the way down the hole. It would just kind of, sit maybe an inch or two down in the hole. So you still got that satisfying, okay, it went in the cup, but you didn't have to reach down as far.
Yeah, that sounds like you were probably a little fancier course than I was at.
Oh, I was not. I could tell you some stories, buddy. At this golf course, when they weren't running well, to lower their operational expenses, you know what they did? They just made the green smaller.
Oh, that's funny.
Now, speaking of Texas, our last asset that we're going to walk through on our 400 theme CMBS tour is the Sheraton Dallas Hotel here, Lonnie. And this one is a biggie. It's at 400 North Olive Street in downtown Dallas. The property backs the SDAL 2025 DAL deal, a $300 million SASB deal secured by the borrower's fee simple and leasehold interests in the 1,841 keys. The loan was co-originated by Goldman Sachs and JP Morgan, structured as a 2-year floater IO mortgage with 3 one-year extension options. There's also mezzanine debt in the capital stack, bringing total debt to roughly $335 million, or about $182,000 per key. Proceeds were used to refinance prior debts, including a 2024 CMBS loan. So this is a very current example of a large hotel refinance making its way back into the SASB market. The collateral itself is a big one. Quite literally, the Sheraton Dallas is the largest hotel in Texas by room count, with 3 hotel towers, a convention center component, more than 230,000 square feet of meeting and event space, 5 food and beverage outlets, an outdoor rooftop pool, and a major downtown location near Deep Ellum, the Arts District, and DART Transit. So the sponsor on this deal is a joint venture tied to Elliott Investment Management and Chartres Larging Group. They acquired the hotel in late 2017 and invested roughly $90 million plus in renovations, including guest rooms, the lobby, meeting space, food and beverage areas, mechanical systems, and back of house improvements. That renovation story matters because the property's ADR improved meaningfully from pre-renovation levels, and the prospectus points to strong group demand and World Cup related forward bookings as potential tailwinds. The credit story is not without some nuance, though. For the February 2025 trailing 12-month period, the hotel was still running only about 50% occupancy, with ADR of roughly $179 and RevPAR sitting just under $90. So this is not a stabilized trophy resort story in the same way as some of the other 400 address loans we talked through. It's really more of a major convention hotel recovery and group demand story. This is a large asset, a big renovation that requires big room blocks, and a Dallas market with several demand catalysts. Really, the big thing for this asset is the renovation that's going on at a nearby convention center. And unfortunately for the asset, Southwest, I think their biggest long-term contract, and Southwest canceled that contract, which basically just eliminated thousands of room nights for this hotel. So it's got it's still a good ways to go to getting back to stabilized, but it's at least moving in the right direction, but not without some risk to keep your eye on.
Yeah, this hotel, I've stayed there a few times, Stephen, and actually done some presentations there. It's very unique. To get to the convention space, you go under the road, and it's detached from the hotel. And it's not, I mean, I know they renovated in 2017. I'm trying to think the last time I was there probably was prior to that renovation, or maybe just after. I'm not sure. But I remember at some point, maybe around 2014 or 15, I think this traded, and the talk track was that they were going to tear this down and redevelop it, because it's had a long history of just barely getting by. It's just a massive operation, number of rooms, the amount of meeting space is significant, and it's just a tired asset. I mean, I know they put a lot of money back into it, 90 million, but I don't know how far that goes on something like this. It's a very notable hotel. I mean, when you're driving through Dallas, it's hard to miss. But I wouldn't be surprised if, because you said this was on a two-year floater. We'll see how this plays itself out.
Yeah, this of all of the assets we've talked through, this would be the one I'd be keeping the closest watch on in my portfolio if I had exposure.
So thanks, guys. That was really interesting. And honestly, I think it's a great example of why we've loved doing this show for 400 episodes. Sometimes we have an out there idea, like looking at properties with addresses in the 400s, but we end up talking about the ins and outs of the deals and really give the color on why it matters. So that's something that's been really fun about doing this show. Before we wrap today's episode, we do have several programming notes and a lot of shout outs, so let me get through those. So at the CREFC conference this week, and across our Trepp channels, you may have seen that we released the latest edition of the mid-year magazine with our friends and colleagues at Commercial Real Estate Direct. Now, this is a half-year recap of the commercial real estate finance and CMBS markets, and this edition explores the improving conditions across CRE finance, from accelerating lending activity and CMBS issuance to evolving refinancing and risk trends. In this year's magazine, we have stories including multifamily Freddie Mac originations up 30% and Fannie Mae funds $17.1 billion in the first quarter. CMBS delinquency volume increases so far in 2026 to $45 billion. Data center inventory continues to balloon, and CMBS issuance soars on the back of SASB deals. There's a lot more stories in there, but if you haven't checked out our magazine yet and you'd like to see some of the insights, find it on our website, our social media channels, or send an email to podcast@trepp.com and we will give you a copy. We've mentioned the Market Pulse webinar several times, but if you'd like to join us, that is taking place on Tuesday, June 30th at 2 p.m. Eastern, and we'll dig even further into that new issue trends segment that Stephen ran through today, and we'll look at recent CMBS new issuance trends through the lens of loan purpose, and again, looking at refinance and acquisition activity. We'll also dig into value-add multifamily, specifically looking at 1970s vintage assets in CRE CLOs. So this will give our audience a closer look at older vintage multifamily properties that have been financed through CRE CLOs and how the value-add business plans have performed and what recent valuation trends say about the risk profile of these loans. And we'll also close with a self-storage deep dive. So reach out to us if you'd like to sign up for that webinar. We love hosting these every month, and we get hundreds of you joining monthly who then become clients or learn about other tools and data points that you would like to hear from the Trepp team. We'll also be hosting our next client-only Trepp CRE targeted training in June, so reach out to us if you'd like to get access to that if you're a Trepp CRE client. And our product team will be demonstrating how to leverage Trepp AI and integrate our MCP servers to really enhance your workflows. So if you're interested in learning how our data can connect to your AI instance and work directly with your LLM or your model, reach out to us at podcast@trepp.com. Our clients can join this one, but if you're not a client, we would love to get on the phone with you and walk you through our Trepp AI tools and how we can get you our data through an MCP server. And turning to shoutouts, Amin Y reached out to us about our Future Leaders program and several of our other academic initiatives. I'll also give a quick plug here for our Future Leaders program. If you're listening to this show, we've already announced our Future Leaders, so you can find those on our LinkedIn or across our channels, and next week we'll be giving some shout outs to those individuals as well. Ian S. is a longtime listener and said, first time, I think, emailer. He was interested in the retail stats that we mentioned in a few episodes ago, looking at retail origination. So we shared that with you, Ian. And then we got a lot of great emails, LinkedIn comments, and messages about the 400th episode. So I'll start here. Our friend Mark Sleeper on X, who always gives us great commentary, said, amazing job by the entire evolving team. He knows that we've grown our marketing team tremendously, and we have Carly and Mariana here on this podcast right now who are our producers. So he gave us a cheers. Albert T said, congratulations on reaching 400 episodes. This is an impressive milestone. Our company began focusing on multifamily finance last year, and that is when I started listening to your show. Since then, it has become one of the best podcasts in the industry, consistently insightful and highly relevant. He appreciates the depth of analysis and market perspectives and plans to keep listening for a long time to come. So thank you, Albert. Charles C congratulated us and said, keep up the good work. Nelson T is a longtime listener and said, I keep you guys on topic, but you guys are always on topic anyway. He really enjoys Lonnie's ability to break down dense topics and always appreciates Stephen's vast knowledge. The banter between us is excellent. So thank you, Nelson. Lee H said, we do a great job. He loves the balance of economic and CRE content and listens on his weekend runs. We love to hear where you guys are in the world when you're listening. Our friend Brandon B said, congratulations. Michael H appreciates the progression from the macro point of view to some micro and market views, and he loves the green shoots. He even listens to it on the weekends while he drives his boys around, and they don't complain. So props to you, Michael's kids, for dealing with us every weekend. Louis G. leads acquisitions and developments for multifamily and mixed-use projects throughout the U.S. and said that our show is one of the most informative podcasts out there. He's constantly learning new things from our podcasts and is interested in becoming a Trepp client again. Our friend Chris M. congratulated us. We've loved working with you and your teammates across the years. We've had several of his colleagues on the show. He said our show is an amazing source of data and presented in an engaging way and wishes us success. Rory A. loves the show and said when she was first introduced to the commercial real estate world, a colleague mentioned the show as an essential source of truth and was immediately hooked when she started listening. Kyle M. has been listening since the end of 2023 every single Friday. At the time, he was trying to better understand what was going on in the market, and when he stumbled upon our show, he got hooked. Cedric F., who's been a loyal listener, said what keeps him coming back to the show every week is the consistency of the format from the very beginning. He says we've done an excellent job of making complex commercial real estate topics timely, understandable, and useful on a weekly basis. He said over the years he's both learned and taught multiple concepts from listening to our show. So thank you, Cedric, for the kind words and the thoughtful reply. And our friend Mitch G., who's been a loyal listener, said, congrats, you guys rock. And Lonnie, you shared about our 400 milestone on LinkedIn, and we got a lot of great feedback from listeners. So loyal listener and friend Jonathan P. said, time flies. I've been listening since episode 4. I always enjoy the green shoots and getting into the details on the deals. Grayson J. said, 400 episodes is no small feat. Thanks for the insights, data, and thoughtful discussions. Liam M. actually called out some of his favorite episodes. He said 370 and 371 were great. I really appreciated the perspective and insight on 2025 and our outlook for 2026. Jerry W., who's been a loyal listener since the very beginning, told us that and said, I've been listening since the first few episodes. I always look forward to the next one. It is especially interesting when he knows the deal that is being discussed. We love to hear that. And if you're ever listening and you think you have a deal or a story or a project you're working on that we should cover, send it to us and we'd be happy to talk about it. John J. has been listening for years. Excellent content that goes beyond the headlines. We have a well-organized and thoughtful show. Jeff I., another loyal listener, said, great milestone and congratulations and on to the next 400. So that is how we are also feeling. We're ready to hit 800 episodes soon. Jaron R. also shared some of his favorite episodes and said, number 343, where we dug into commercial versus residential real estate drivers, was one of his favorites. He really enjoyed the talk about the nuances of both sectors. And then a close second would be number 365 when we did a ground lease 101 segment. So thank you so much to everyone who's reached out. I just have a few more shout outs here. We met a lot of listeners at CREFC this week, so I'll run through these quickly. Kathy T. was a huge podcast fan. She came by our booth to say hi and get some swag. We had a lot of cool swag there. So if you're a listener and you're curious about any merch with Trepp or the TreppWire podcast on it, reach out to us. Kat W. is also a huge fan. She said she was introduced to us from a colleague 2 years ago and has been listening ever since. Ian G. is a huge fan. Abby M. is a student who said her professor at the University of Denver sends the podcast to all his students and requires them to listen every week. So we appreciate that professor and you, Abby, for listening. Iris T. has been a podcast listener since day one and says she listens consistently every week. We saw an old friend, Michael Watson, who's a longtime listener. He said he thinks our show improves and is more engaging with every episode, and he is excited for us to hit the 400th milestone. Alphonse B. is a big listener and asked us when we're doing our next live show. So maybe we can come to a town near you and do a live podcast. And then as we do at every CREFC, we meet with Stuart Rubin of New York Life Insurance. And we always talk about such interesting topics. I have a few highlights from our conversation with Stuart here. We talked about how the oil crisis could be worse when you look back at other crises, the magnitude of AI's impact, and that it's not going to be a nothing burger. We talked a lot about rationality versus judgment within AI. And then we dug into some of Lonnie and Stuart's picks for emerging markets. And they talked about Northwest Arkansas and Alabama. So maybe, Lonnie, we can get into some of those markets and your reasoning behind that on a future episode.
Yeah, we're going to try to have a segment here coming up where we highlight some emerging markets. And it's always great catching up with Stuart, super knowledgeable on all things, not just real estate. Very well-read gentleman and always gracious with his time. And we always look forward to catching up with him. And, as you mentioned, Haley, I mean, we have hundreds of people that emailed us or Slacked us or emailed us or DM'd us or, connected with us on LinkedIn or came by and stopped by the booth at the conference. I mean, 400 episodes for us is a pretty significant milestone. And it just makes it all the more real when you hear people that support our show every day telling us how much they enjoy it and, which episodes maybe move the needle for them or whatever. And so super excited that we're able to share this together. We got a great team here. We all row in the same direction and work really hard to make this an insightful and impactful podcast week to week. It's not an easy feat, but like you said, here's to the next 400. Let's get this thing going.
And with that, we'll close episode 400. Again, before we go, we just want to say thank you to everyone who listens each week, sends us notes and questions, even critiques, stops us at conferences to meet us, tells our other team members that they love the show, joins us as a guest, or shares the show with their colleagues or on social media. We truly appreciate it. Again, what started as an idea in 2020 has turned into 400 episodes, nearly 2.5 million listens, and a real community. And that's what we've tried to build with this show. So we will continue to do so each week, breaking down the headlines, tying it all back to commercial real estate. And we're extremely grateful that you've chosen us to spend part of your week with. We know sometimes we have a long episode, but we love this. We love what we do, and we're excited to keep the conversations going. So thank you again for helping us reach this milestone, and thank you for listening to the TreppWire Podcast. I'll thank our producers, Carly Cento and Mariana Sabrana. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or just a comment, send an email to podcast@trepp.com and subscribe to the TreppWire Podcast with your favorite provider. Thank you for listening and stay well.
All right.
All right.